constant question we're all asking ourselves is, am I invested the right way given my age? Or even, what are other people my age doing in their investment portfolio? Well, I don't have all the answers, but what I can do is give you some things to think about in your investments, whether you're in your 20s, 30s, 40s, or 50s. An individual investor's biggest advantage is time. The stocks are a function of company profits, and so as long as company profits generally rise over time, stock prices should generally rise over time. And as long as the economy is generally growing, stock profits should generally go up. And the more time you give it, the more likely all of these statements are to be true. So if you're in your 20s or 30s, take advantage of this huge amount of time that you have, which you could do by putting as much money as you can into stocks. Now, this does require that you know what you own. So if you look at your 401k and you find that you're in something called a target date fund or an asset allocation fund, you might want to think about making a change. Even if that target date is far away or the asset allocation says growth, it still might own a fair amount of conservative investments. And at your age, that's just not necessary. You can control your own asset allocation by just owning a diversified mix of stock funds. Now, if you're in your 40s, first of all, congratulations. But second of all, the story is not really that different. You might be thinking about retiring in 10 or 15 years, but that's still a pretty long time horizon. In US history, there's only been one 10-year period where stocks produced a negative return, and that was the 10 years that ended around 2009 into 2010. Bear in mind that that included both the 1990s internet bubble bursting and the 2008 financial crisis. In other words, it took not one, but two major crises before you saw stocks produce a negative 10-year return. Let me put that a different way. If you started investing in 2007, horrible timing. 2008 was about to happen. But by 2017, you still had a positive return. And if you're trying to invest to make money, you may as well invest in periods where there's going to be a positive return. So what I'm trying to say is we're investing to make money, right? And if most periods are producing positive returns, then it behooves you to be invested in most periods. In other words, we get some periods where returns aren't as strong. Maybe there's one or two recessions. Some periods where returns are really strong. Maybe there's no recessions. But if it's consistent that usually over these time periods you make money, you may as well put your money in the market. This is an old Wall Street saying that stocks are kind of like a drunk guy being led home by his dog. The dog knows how to get home. Might not take the most direct route, but he's eventually going to get there. And I think stocks are most likely to, eventually make money. They might not take the most direct route to get there. Also in your 40s, remember that you need this portfolio to last you maybe 40 more years or more. And so you need enough growth in your portfolio, not only to sustain your spending habits in retirement, but also cover you for inflation. So that probably means in your 40s, you still need a pretty heavy stock portfolio. So in your 50s, retirement could be getting a bit closer. And now we got to worry about something called sequence risk. And sequence risk just means the chance that stocks suffer a big downturn just after you decide to retire. And there's a few things you can do to mitigate sequence risk. But the best thing you can do is grow your portfolio enough while you're still working to mitigate the effect of a downturn just after you retire. So for example, I knew a lot of people who were thinking about retiring in 2020, but then COVID hit, stocks took a big downturn, and suddenly that was a lot more difficult. Now, as we know, stocks recovered all of that loss and then some in 2021. So if you had gone ahead and retired in 2020, you would have permanently impaired your spending power in retirement. Whereas you'd waited another year, you would have eliminated that problem entirely. So you can kind of think of it like this. Plan A is just to have your portfolio grow enough that you can withstand a year or two of negative returns just as you retire. But plan B is if there's a bear market just before you retire, you could stay in the workforce another year or two and allow stocks time to recover. I think this two-pronged approach is your best defense against sequence risk. Now look, no matter what your age is, there's no one size fits all for how you should allocate your portfolio. A lot depends on your personal circumstances. So that includes things like your income, whether you have access to a pension account, maybe you might be expecting an inheritance, your tax circumstances, or even just goals you have that are beyond retirement. But whatever age you are, I encourage you to think about your investments in terms of the time horizon you actually have. So look, those are my ideas about what to do at each age. But if you have any questions or comments, throw it in the comments section below. And if you like this content, we're going to be coming at you about once a week with thoughts on the markets, on the economy, on the Fed, everything in between. So hit that subscribe button. You'll be the first to know when we have a new video out. We'd love to see you again.